This is all very new to us, so we really appreciate you giving us the benefit of the doubt for this platform as we've kind of all had to adjust and change what our work life looks like. I'm now on week 4 of working from home, so many of you I've been able to connect with already, but many I haven't met with so far. And this is really just to address the fact that we are still doing things behind the scenes to manage your portfolio, regardless of our capacity to meet face to face, regardless of our ability to sit down with you in a one-on-one and readjust what your lifestyle has looked like. We are still consistently managing through this volatility. I want to give you a little bit of a background as to what that's looked like from our perspective and some of the things that we're monitoring as well. For those of you that I haven't had a chance to meet with, I also do want to give you a bit of my background. But before I really get into anything, there is so much of this is going to be focused around the volatility that we've seen largely in response to this coronavirus pandemic. And it's very easy once you get going on the economic aspect of this to lose sight of the human aspect of this pandemic. And particularly with our involvement in the medical community, I mean, we've never been more proud to be able to support this community than we have been in tying our causes together, really. And that this is a challenge that we're both having to face. So I had to close the window there. And we're going to do our best to take care of this aspect such that our physicians and our medical specialists can get back to delivering what they do best. And this has really just been an incredible opportunity. We thank you so much for everything you're doing, be it on the front lines, be it being there to support your family through this, and just a sincere thank you on behalf of MD. I know that we're all extending the full invite that anything we can do for you, if it's taking a bit of a load off in terms of corresponding for year ends or dealing with your accountant, we're happy to do everything we can to step up and support you in this time. But where am I coming from? So I'm actually relatively new to MD. I actually only joined the firm in just partway through January of this year. I've been in the financial services industry for the past 11 years. The past 6.5-ish of this has been doing exactly this. So discretionary portfolio management, largely in the high net worth space. And I started out with Connor, Clark and Lunn Private Capital. So lesser known name on the retail side, but we were a larger institutional player, so managing money on behalf of the banks, managing a portion of the Canada Pension Plan. My focus there was still on the family, on endowments and foundations, a lot of which are still some pretty fairly known names in BC. And for the past 2.5 years, I've been with RBC Phillips Hager North Investment Council, and my focus there was more on the family enterprise, so where there was more corporate structuring involved, more complex estate and trust planning issues. On the educational side, I hold the Chartered Investment Manager designation. So that's through the Canadian Securities Institute. It's the highest accreditation you can get from them for exactly this, investment and portfolio management. And I have the Chartered Financial Analyst Charter. So the CFA Charter is widely regarded as being the golden standard for the industry. And it's not even really for its the level of analytics involved, but for its emphasis on ethical decision making and transparency and promoting those values in an industry that has had its challenges with that. So while I'm relatively new to MD, I'm very, very familiar with the platform. I've been in, it's a very competitive industry. I've been reviewing their portfolios for years. Made the decision to come aboard because I was in full support and familiarity with their managers, and at the same time, I mean, I've got time on my side here, and I have to take a look at who do I want as my clientele, what platform allows me to deliver upon the investment philosophy that I've long believed in, with a clientele that I want to work with, not only just in at the end of the day organizing a portfolio for retirement, but in being a part of that planning process and being present through the accumulation phase. Because there's so much that is done in leading up to that, and I don't just want to be sitting there at the the finish line waving the flag to get everybody across. So that's more so where I'm coming from, but I'm going to take this over into the direction of what we're doing on the markets, given all this recent volatility and a lot of the headlines that we've been seeing. So we'll cover a little bit about just more generally how we look at the investments within your portfolio. what we're looking for economically to decide, okay, do we lean in one direction? Do we go to the US? Do we go to Canada? Is fixed income attractive right now? And then as well, we'll talk about, the past quarter, what set the stage, what things were looking like coming out of 2019, because that, as I'm sure you can imagine, has been an entirely different picture to what's unfolded. To say this is unprecedented and unanticipated is a little bit of an understatement, and it's a rarity that we'd have a pullback that has been influenced by this exogenous shock. What started out as a disruption to the supply side of the economy, but now throughout lesser employment, people are getting laid off, businesses are closing down. It's largely creeping over to the demand side. And this is a little bit of a reversal from what we've seen historically in terms of organic slowdown from an economy standpoint. We'll cover some stimulus measures because that has been the word of the day over the past couple of weeks. So we've got our regular toolbox for that, where we try and influence interest rates within an economy. We like to throw this word around, quantitative easing, and it's all well and good. The markets seem to rally anytime somebody says that. But what does that mean, and what is that actually doing? Is it long run sustainable? We'll talk a little bit about that. And most importantly, we say a Q&A session at the end, questions and answers, but I want to keep that rolling as much as possible through this presentation. So if something comes up that you would like me to speak more to about, I'd really encourage you using that, I believe it's a chat box there that will show up only for myself and Stephanie, the organizer here, where she'll interrupt me and read that out, and we can talk a little bit more about whatever you're interested in at the time. So we'll go back to, just start from the ground up here. How do we look at how to allocate your portfolio? What are some of the things that we look at? And this is what gets brought out in every investment strategy meeting that we'll have together, is that there's two different ways we look at this. And I work in tandem very closely for each of you with a financial consultant that takes on a lot of your financial planning work. So we always really start by trying to construct from the ground up what we're trying to do here. And that starts with a financial planning process. It starts out with you saying, what am I ultimately here to accomplish? Because at the end of the day, we can talk about the markets, and I'll take excuses like this to do that for you. But it's not really relevant unless it's supportive of what you're trying to do here. So if that's, I want to sustain this amount of spending or this lifestyle in retirement, then that's the objective that we're going to work towards. If it's, I want to be able to spend this much on a house or just provide this much to my kids, well, we'll take care of the part where we put some numbers behind that, but that's the extent of your involvement that I want you to come to me with, is here's what I'm ultimately looking to do with this. So there's two ways that, and it comes down to how we break that down, because if we're looking to grow these portfolio assets, well, what do we have to have before we have growth or appreciation? We have to be able to firstly preserve what I have, and not only preserve what I have, but preserve the value of what I have. And through that lens, if I'm looking at it, I say, well, the cost of living is going to go up. It's going to go up about 2% a year on average. This is just the nature of inflation. We do need to be able to beat our investment management fees, so we'll add another percent to that. So we'll have to beat 3% in order to just be able to break even. So where I'll then go back to your financial consultant, and a lot of the times we'll even do this in a meeting together, is say, what real growth do I need beyond that 3% to be able to meet my objectives? And I apologize that this is coming back to a lot of discussions for you that we've already had, but it all does build onto each other, and this is how we look at what we're trying to isolate in terms of a rate of return. For some of you, you might be leaning more towards a growth aspect, because I need that growth over time to be able to sustain a goal in retirement. Some of you are at a stage where I've worked, I'm at the end of my career. I don't need to take on extra risk. I don't need to be exposed to all this up and down volatility. I'm okay with a solid yield and just preserving the value of what I have, and that'll support my lifestyle. Well, we might not be leaning more in the growth direction. We might be more conservative. Everything that I'm going to talk about in terms of what we're doing on the portfolio level, in terms of our tactical positioning, we say, is applicable to everybody. Whether or not you've told us that you're more growth, more conservative, we're making the same moves to different extents on all ends of the spectrum. So coming back to one layer of how we manage that is we take a look at, well, what is, first of all, the objective, and then we come forward with a long-term strategic mix or investment strategy that's supportive of that. You know, our financial planning process, and I hate to reuse this analogy, but I always look at it as being, you know, setting our GPS marker further out there. You know, if it's our investment strategy is in a ship in the water, and if we are, you know, if it's all smooth sailing, this is the route that we'll take. We'll just go straight over there, and that would look like, you know, for a growth portfolio sitting in about 4% cash, about 22% fixed income, and the rest being just a selection of Canadian, U.S., international, and emerging market equity. A little bit of alternatives. We'll talk about that a little bit later as well. But you employ us with Private Investment Counsel to make some decisions along the way. And it's not going to be a run to cash as soon as we see a storm off to the coast. We know where we need to get because you've told us where we need to get. We need to be organizing this portfolio for a longer term such that we're better able to weather these, you know, through some minor sale adjustments and getting a little bit defensive. And what that looks like traditionally for a portfolio is that we would run that through just a fund. We would use this fund. It's called the GTO, the Global Tactical Opportunities Fund. It's a component of the fund of your portfolio for about 95% of you, where it's our vehicle to express our views. So we might lean a little bit more to the US side. We might lean a bit more to Canada. We might lean a bit more into the fixed income versus equities, much like we've seen quite so far. But it's usually in the smaller leans range. So you can see where we normally be at about 4%. We're a bit over in cash on 5.1. This is the first time in years that we've been close to even on fixed income. Traditionally, we'll run that significantly under just because bond yields have not been very high for a long time and trying to support equity growth. Fairly neutral on Canada and a little bit over on US. Now, if we were to look back, you know, close to a year ago on US, we were significantly over, and for a good reason. I mean, there was a lot of economic indicators that were signaling that we had further growth on the runway for the US. We still believe they're the most poised for recovery at this point, and still have maintained a little bit of an overweight in that direction in order to capitalize upon that. But this, you know, 3-4 weeks in quarantine has given me time to come up with some additional metaphors for what we do here, because this sailing ship is getting old at this point. So I had to kind of look at what you know, what have I been doing besides puttering around the house? Well, we made a trip to Costco pretty recently, and this, I feel, works a lot better with what our process is here on an ongoing basis and what we're ultimately trying to accomplish here. If I'm trying to bridge that gap where I need to, you know, keep things even, you know, I can do 2 to 3% reliably on a fixed income mandate. To what degree do I need to seek out further growth? And this is a constant and evolving search for yield. Where do I get these returns above the rate of inflation such that I can be able to provide you the return you're looking for in retirement? So we come down to, okay, well, what are these things? Well, cash does nothing for me. I mean, cash, you might tell me that, you know, let's say I have a picnic coming up, I might need to purchase some extra cutlery because I'll have more guests. But that's not really what we do here. It's a means to access really the nutritional value and return value that we're going to get from the investments that we hold. We might do that temporarily to raise cash for something that you need. However, I mean, there's perfectly good cutlery stores everywhere, right? These are your banks. You can, you know, get a solid cash return by just putting cash in with a bank and, you know, not expect it to appreciate. What we're more here to organize around is balancing out, okay, well, we've got fixed income investments that we can use to return some of this yield. We can't rely on that to be able to deliver above the rate of inflation, above the rate of fees on an ongoing basis. So we do have to look to where we're going to get that, and it's primarily stocks and equities. That's why when I'm asked a lot of the time, you know, in a lot of these reviews, well, we knew things were overvalued, you know, why did we not run to cash? Well, I mean, that's great in theory. It's really good if I were to be able to call that. I mean, this was a pandemic that was emerging. We could have avoided this drop by running to cash. And in the same strain of thought, really, I think, well, I mean, last year was phenomenal. Outlook was really great for U.S. equities above all else. Why were we not 100% U.S. equities when that returned over 30%, you know, the year before? Well, we don't know for certain. We don't know for certain. And we're not sitting here trying to time the market. It would be a little bit silly of us to be able to say that we could do that. If I did have the crystal ball, I probably would not be here right now. But when we've got the leading economists for all of the major banks doing their best to hone down probability of recession within the next 2 years, for me to be able to sit back and say, okay, well, I've got it down to this cause and it'll be persistent for this month. It would be ignorant to even say I've got it down to the right year, let alone the right month or the right week. So that's a little bit of an explanation as to why we do this through calculated risk reduction lensed leans in one direction rather than running in larger swings to one asset class. And this is part of this investment policy. This is the document that we both sign off on, where you say, here's what I'm ultimately trying to accomplish here. We say, well, here's an investment strategy that will work and is supportive of that based on our expectations. Here's what our targets would be. So for both fixed income, we'll say about 38, 39% for a balanced portfolio here. We'll say Canadian equities 12.2, US. But with that, you can go up to a maximum of 53% fixed income. You can go down to a minimum of 23.4 or 23.5. And the same thing applies to equities. So we do have leeway to go up to generally about, well, in excess of 15% on either side, roughly 15%. So we do that, we take advantage of that. It's reflective of our views, but we would never really be from a point of investment philosophy at a point where we're saying, here is the bottom, we're going entirely equities, here is the top, we're going to dial back to cash and fixed income. So this has been a little bit of a recent development as well, as at the end of March, is that we would traditionally, as I mentioned, express these views through one fund we have called the Global Tactical Opportunities Fund, the GTO, if you will. What we've then had to do, because this is an unprecedented level of volatility, is take a look at some other ways to be able to de-risk. And you can see there's 3 ways that we've done this so far as at the end of last month. One is the GTO, that's our traditional measure. We have also included a de-risking through what we say is our tactical asset allocation. I'll explain that in just a moment as well. And then as well, there's been a fund contribution. So when we come back to just looking at your overall investment strategy, we know that most recently, Canadian equities, US equities, international equities have all taken a significant hit. This is the volatility that's been dominating the headlines quite recently. We've watched what's happened to our portfolio and watched as those market values have shrunk. So when that happens, of course, those asset classes make up less of a proportion of our overall portfolio. In turn, because they're not hit as hard, cash equivalents and fixed income become more of a proportion. And this is what we could say is our tactical asset allocation, where we would rebalance that under normal circumstances. We would look to maintain our same equity weights. We've made the decision that no, we're not going to do that. We're not building up an equity position in falling markets right now until we see sentiment improve, until we see stimulus improve, until we see containment improve on the coronavirus front. We're looking for that opportunity to reemerge and go in that direction in a big way, but it's not quite yet. So we're going to build some more clarity around what that is, because I mean that was the first question right off the bat is I've got cash. What do I do with it? Is now the time to go risk on? Well, do I think that equity market growth over the next 5 years will be above where we're at right now? Yeah, I think there's a lot of solid cases in that direction right now. Do I think that if we put it in right now, we're maybe going to look a little bit silly for perhaps even a year, maybe even beyond that? Yeah, maybe. I'm not going to be able to call the absolute bottom for you here, but I will be able to give you some context around our views as to why that may not be the case at the time right now. The other contributing de-risking that I've just kind of touched on was the fund contribution. So even where we may see that I have an allocation to X amount into Canadian equities, a Canadian equity fund, well, we employ a Canadian equity fund manager whose job it is to keep their eye specifically on the Canadian equity market and watch as this volatility unfolds and say, okay, well, where are our best bets right now for one, staying defensive, and then where do we get opportunistic? And it's a process right now. And we're watching this play out on the capital markets in this, we've had this phenomenal drop down, and we're seeing a rebalancing right now, and it's providing some downside support in that we have these fund managers, these equity market managers, sitting with, let's say two stocks down 50%, both of them. One of them is an energy stock, highly reliant on oil and gas. The other one, we'll say, is a restaurant stock. Of course, as everything has been shut recently. So given our outlook and what do we expect to rebound more quickly? Well, probably the restaurant stock at this point, because if we do show signs of containment, they will resume business and come back into a lot of pent-up demand. There are still factors right now that are suppressing the oil and gas market. So this was kind of added fuel to the fire in this pullback that we've been seeing. We'll touch on a little bit more in a bit. But that's going to definitely be a long-term recovery unless there's, a miracle deal struck between Russia and OPEC tomorrow, where they say we're going to restrict the output of gas. But there's a lot to say that that's not going to happen, and I bank my probabilities at this point on a containment and restaurant recovery before I would bank on the oil side. So we've been actively shifting. That's what the fund contribution looks like. As we've sold out of some positions we don't believe have potential for further growth, reallocated to where we do believe there's opportunities, and keeping a reserve of cash as well within the fund itself to be able to deploy into opportunities as they arrive. So it's a multiple layer de-risking process, and it's what we've implemented in response to this recent volatility that we've seen. And the research here backs up that approach. I mean, we don't want to be bouncing and trying to allocate to the number one shoot the lights out asset class on an ongoing basis. The research says that if we're invested for all trading days, and this is looking at specifically the US market, but it does apply across all, invested for all trading days will be generally your highest rate of return at a certain risk level. If we were to go to cash and then miss just over the top week, we're looking at reducing our expected year-over-year return by over a third. If we were to say, okay, you know what, I just want to go to cash for 3 weeks, wait for all of this to blow over, and it turns out those 3 weeks are that was the turnaround, then the year over year that we'd expect to get out of this asset class, out of US equities, goes down to less than half. We get about 3.5%. So we do, there is a rhyme and a research supported reason behind these calculated shifts that we'll make in one direction. The thing about, and why we've seen a little bit more volatility out of this past little bit has been the rise of passive investing. And this is index ETFs. This is people going in and saying, well, I don't need to select a certain stock or even look to, what is value oriented versus growth oriented. I will just get my exposure by buying a handful of the Canadian market. So a selection of the Canadian stocks, and it's based on who has the largest market cap. I'll do the same thing in the US, by a US index ETF. I'll just follow the performance of the broad US index. And the thing about this is that investors as a whole, same thing with running to cash, are absolutely terrible at doing this timing. I mean, that's why we are at least acknowledging that we cannot do this, but the investing public is trying and successfully failing. So what I take a look at is how investment performance, and this is just a composite of the global market index, so including North America, Europe, Asia, everything, compared to the cash flows into these equity markets. So that is your light gray here. And you can see when things are going well, cash will pour into equity markets. And we stick with the time and tested thing where we're trying to buy low and sell high. This chart really demonstrates, when things are going well, the investing public buys in. Where do we see the capital outflows? Well, we're looking at, the 2000, the dot-com crash here, mass exodus from the markets when things are going poorly. The largest outflow of capital from equity markets that we've seen has been during the financial crisis here. Of course, selling out while things are bottoming. And if we look for a parallel here, well, we're saying, okay, do we Do we use this as an opportunity to buy in? I mean, would you feel okay buying in at this level here? Probably you would. Even if we looked silly for a little bit afterwards and people kept pouring money out of the markets, over the long run, I would be happy because I know that that rebound is coming. And it's so this really only takes it up to end of 2015, but the research is really there that we're, as an investing public and as an investing community, really terrible at trying to time the markets, and there's no sense really trying to do so. What we do try and set up is a longer term mix that we know based on our expectations for the returns of these asset classes that will get you there over the long run. So we'll look at, this is just, for instance, the Canadian market. Of course, we have to take a lot more up and down on the equity side of the equation. This yellow is the bond market, which of course returns are not very exciting, but are trending upwards. This is coming back from 2007 to 2017, so a 10-year history. And then the gray line is a combination of the two of them. So you can see at the end, they largely get you to the same place, but we've smoothed out significantly the path of returns that you're taking on your way to get there. We might lean more in the fixed income side of the equation if you are just looking to preserve the value of what you have. We might lean more to the equity side of the equation if you are looking to get that, the further growth. But you do have to accept that there's going to be more of an up and down through that process. And if we're looking just back at over the past month, well, this is, it's almost a little bit comical at this point that we're continuing this process, but we are flowing out of equity markets. Cash is flowing out of the equity side, even on the fixed income side, and seeking out returns on cash. Returns on cash are zero. But if we're looking back at, again, 2019, we should have gone 100% into U.S. equity, gotten our 30%. Who is to know that for 2020, your 0% guaranteed on cash would have been preferable to this market volatility. It's important as well to keep in mind that with a pullback of this size comes opportunity, right? This creates just as much opportunity as it does downturn in volatility. It's an opportunity for us to look at, okay, what do we now think, given this new economic landscape, is going to work out for us? What do we think we need to cut our losses and avoid going forward? And this is a constantly evolving process, and it's just furthering our search for yield and search for being able to bridge that gap in between, just preserving what we have and meet your objectives. So more specifically into what this has looked like on the fixed income side of the equation, because fixed income has been the outperformer over the past year, as we've seen a bit of a pullback in the first quarter. And it's important to remember that to this point, because it gets so easy over over a longer time horizon to look at these fixed income investments as us lending out to the government of Canada, us lending out to the provinces, to a lesser extent high grade companies as well. And it's a loan agreement. This is us lending them money. We get our nice little 2 to 3% return back. And that's usually about the extent of it. This is why I categorize them as the vegetables in this balanced diet shopping list that we're looking for. Is generally they're not very exciting unless you decide to do something special with them. But this has been the outperformer because, as you can see, there was a trend in interest rates going up over time. So this is going back to 2015 until late 2018. This was the central banks who set our interest rate policy, saying, this bull market cycle has gone on for very long. When that happens, profits are good, companies are hiring, employees are getting paid substantial sums, and it leads to traditionally a little bit of an inflation. And it comes back to that idea that if everybody is getting paid $100,000, effectively nobody is, because the price level just responds to the fact that everybody has more money. So in order to avoid that, one of the tools at the central bank's disposal is the ability to influence interest rates. So when you make interest rates go up, it gets more attractive to save on the sideline. We decrease, the velocity of money through the economy. Businesses don't borrow as much because it's more expensive for them to borrow. They won't hire as much, and you slow things down. And the goal is to keep things at a nice level medium. The market did not like that one bit. They put a little bit of a hissy fit up, I would say, in December of 2018. And it's always nice to look back and reflect and say, okay, when was our last corrections? And we think, okay, the 08, 09 financial crisis. We look back to the oil and gas crisis of 2015. And the one that nobody ever names is December 2018, where we did have 20% wiped off of the US equity market within the span of a month. Of course, it didn't really stick around on many people's radar because the rate of our bounce back was so great. But where it did linger around is telling the central banks, hey, that was premature, knock it off with this interest rate nonsense. So they were pushed really in the direction of lowering their interest rate once again and continuing this run up on the economy and in turn on the equity markets. So fortunately for a lot of our portfolio holders here, you're holding a selection of fixed income at generally a higher yield. And we'll go into a bit as to how this works. But when they say, okay, hey, the new bonds coming out onto the market are going to yield down here in this 1% range, and we were originally invested at about this, 2.5, yours look comparatively attractive. And it leads to a spike in the valuation of those bonds. Part in just the paper return, but also we were able to de-risk and sell off a little bit of the bonds at these higher valuations as well. And it's why over a longer term we'd expect in that 3.5% rate of return on a bond yield in Canada, but managed to post sometimes in excess of 9% for a lot of these portfolios if you were holding the core bond fund, sometimes even double digits depending on what your weighting was. So it's really helped to work against a lot of the pullback that we've seen on the equity side. And I've thrown that out to a lot of you in just in a general concept way, but there was still a little bit of uncertainty I felt as to why is that? So why does a bond become more valuable if interest rates are coming down? So I just wanted to throw together a quick little example here as to why that is. So if we're looking at just what is a bond at the end of the day, and I'll just make an example of a sovereign bond, so government-backed Canadian bond, a 5-year. It is saying, okay, well, I'm the Canadian government. I need to raise money to be able to provide, build this gym or new facility or infrastructure. So I need to borrow $100 from the general public. I promise I will give that back to you in 5 years' time. I'll pay you 2.5% interest for that. And that is, at the end of the day, a bond. It's us saying, okay, well, we'll provide you that financing. We will buy your bond. You can do what you want with us, with it. We'll take your interest, and that's it. So it's bound by contract, and the terms of the contract are, more simply, 5 years. Our interest rate is 2.5%. So we'll say we're going to get $2.50 every year. The total interest over the life, so 5 years of $2.50, we're at $12.50. So afterwards, at the end of the day, I'm getting $112.50 because I get my $100 back in 5 years' time. So let's say as well that 1 quarter out, let's say a pandemic strikes. I, as a central bank, have to lower the interest rates in order to spur the economy, encourage borrowing, get people spending once more. So 1 quarter later, I'm looking to raise another $100. It's also just for a 5-year term. I'm only going to pay 1% interest. That's where bond yields are at now. So my interest per year is just $1. So I'm going to pay out $5 in interest over a 5-year time horizon. And at the end of the day, I'm looking to recoup $105 from this. So if I'm managing a bond portfolio around this, and of course, part of this is trying to sell off bonds when appropriate and be able to reinvest in a secure bond of similar quality at market rates. So what's bound by contract here is what's highlighted by red. Sorry, I made a squiggly there. I knocked my mouse. The part that can change is the price of the bond. So if I'm looking at selling this first bond, the one that was issued in January, just the beginning of the year, what am I selling? What am I selling this for? Well, I'm trying to recoup the value today of getting an income stream of $12.50 over the next 5 years, because that's what I would be promised if I just held on to the thing anyways. but I'm offset as well for the fact that through the rest of the term, I can invest at this, 1% interest little bond as well. So if I'm to look to find out what is the value today of this $12.50 income stream, and what part am I going to recoup by investing in this lower yielding bond? Well, I would sell it for $107.28. And there's time value of money calculations that goes into this, but you can see where the original bond price that I bought for $100 is now worth, just because of a change in interest rates, $107.28. Now that's part of the equation. It's part of it. What happens in practice is that there's expectations that are built into this. So when we have a central bank that turns around and says, okay, I'll initiate the first 50 basis point drop in interest rates, well, the market has expectations that that's going to be continuing to be the case. The central bank never really drops, one interest rate drop at a time. So we started pricing in, even at the first sign of a pullback here, 0.5, 0.25. By the time that we were down here, this 1.75 level, we were forecasting in 0.25 interest rates, or the bond market was. And what that does is lead to more of a spike in this bond price, because we know that when we sell off, I need to recoup my $12.50, but I'll only be able to make 0.25 on the reinvestment that I make. So that's been part of the decision making that's gone into this, and part of why we've seen bond prices hold up the performance of your portfolio. Another part of what we manage around is, you can see that at the top here, this top line is a Canadian 20-year bond. So we make the decision as to, okay, where do I get my best yield on lending out to the Canadian government, for instance? Is it lending out traditionally for 2 years? If I need to keep things very liquid, if I need to be able to access that in the short term, or am I compensated more for lending out at this, 20-year time horizon? I'll be out of pocket for that long, but I'm guaranteed a higher rate to compensate. Well, coming out of 2019, you can see those two figures had really merged very, very close together. We weren't really being compensated much for lending out for a longer time horizon, and we may as well just keep the liquidity and keep everything short term, because there's no incentive to go longer. That's really still persisted. We're only really now starting to see, that spread between a short term and a longer term bond widen once more. But it creates another set of problems that we'll talk about very shortly. But it's part of, just where we are going to be able to search for that yield and bridge that gap once more. So just coming back to the way things played out. I mean, this is more of an understanding now as to how we manage and the decisions that we make, but how has that fit into market events over the past year? And I pulled this from the review that a lot of us went over in early January, looking at the year of 2019 review and what our outlook was going forward. And part of piecing together where we make our equity allocations, is it in the US, is it in Canada, is it internationally, is we look to the manufacturing sector. And the measure that we use to look at that is called the Purchasing Managers Index. In short, all it does is look at key manufacturers, what they have in terms of orders for their goods, and what their current level of inventory is like. So if I have more orders than I have inventory, well, I'm going to produce. That will give people jobs. I believe that there is a demand for the goods that I'm going to put out. So I will have aggregate demand driving up the GDP, we say, global domestic product of the economy. This is what we want. At the end of the day, if manufacturers are happy, we are very happy, and we're positive on their outlook for the growth of their markets. What was showing and was still showing at this point is poised for recovery was the US. So a healthy level of demand for goods, employment was increasing, wage growth was increasing, supporting, if you have a lot of the workforce making strong wages, they have more purchasing capacity. It all builds on each other, right? Like then manufacturers will produce to meet that demand. Even going into this, we were looking to China. I mean, China has been a world leader in economic growth. If we look back to the 1980s to 2010s, we're talking 13% year-over-year growth over that time period. Of course, it's since tapered back, but coming into this pandemic, Consensus forecast from the Canadian commercial banks was growth in the range of 6% GDP growth nominally. When this was showing to be, an explosive pandemic within China, but showing containment, they said, well, maybe 5.6, maybe 5.6 is a downgrade, maybe it's more suitable, and you know what, they will bounce back in Q3, Q4, and the Chinese always ramp up production to deal with pandemics like this. That, of course, was thrown largely out the window. Actually, when they reported this figure in March, after we were showing signs that this had been spread, that was generally around February 18th, they reported this PMI figure down here at 36. And if we're looking as for an example as to a leading economy that had its first bout with coronavirus and what that did to the economy, well, 36 on the PMI, so consumer demand fell. That was in the range of 12% for consumer demand. Manufacturing output was cut by 24%, and GDP growth was cut by 30% over 2 months' time. Now, they were the first to experience this. They since have bounced back to a purchasing managers index of 51, but it's important to remember that that's a month over month. So a one new order for a 49 level of inventory when your previous reporting was 36 is not really the recovery that it looks like on paper. We're still sustaining quite a bit of the fallout from that level of economic quarantine. Just going back as well to the beginning of the year, what was fueling some tensions and some holdback in our positioning on the international side was the UK and Brexit, and trade wars have been really a theme over the past 2 years, 2019, 2018, 2019, largely dominated between China and the US, with Tariff Man implementing, this is what they called him, this is not what I'm calling him, but he was known as Tariff Man, in first saying that he was going to cut off and sanction trade with China. So this Twitter trade policy led to a lot of negative outlook because we do like free trade. The ability for a company to export goods drives up the demand for their goods because we're now dealing with a global market base. And when you shut down trading paths like that, you shoot your demand in the foot a little bit. So there needs to be a demand for the manufacturing of goods within the United States. And when you shut down your trade partners, it's not a long run positive. The same thing was happening through 2019 with the UK and the euro. So that finally came to a head with the UK deciding to leave after first, tabling this as a possibility back in 2016. And we are still of the view at that point that we're going to take a wait and see approach on this. This is the UK backing off and saying, well, we were once prosperous on an energy sector. We were a leader in oil and gas extraction, manufacturing, and distribution. Liquid natural gas was huge. But through their involvement with the EU, we're really pushed in the direction and received financing towards developing London as a financial center to support the rest of the EU, and where the energy sector and manufacturing jobs were provided incentives elsewhere, which led to this theme of protectionism still. And we've seen that come through a lot in the States too, where it's a lot of blue collar workers feeling like I'm not getting my piece of the cookie as well here. We can shove all this stimulus and all of this development into the city cores and London specifically, but it was costing a lot of workers their jobs in doing so, and hence that led to a lot of resentment. There was finally the decision to leave. At least it reduced the level of uncertainty because the market does not like uncertainty. But coming out of 2019, we'd seen a year one deal implemented between the US and China. We'd also seen the finalizing of the UK leaving the euro. So a little bit of a background for the exuberance we saw that led to some really record-setting returns on the equity side, just because of reduction in the level of uncertainty for things that we were dealing with. Down here, and this is Germany down, that was showing in the contraction or recessionary stages even before this pandemic took place. And the only reason that I really bring them up as a discussion topic is, one, we were looking that they were down already. We were looking to potentially invest in and buy into the German economy at some pretty attractive valuations. But they stand out as a leader in negative interest rates, and that is a topic that you might have seen hit the table as well fairly recently, as the governments look towards stimulus measures, because that was at the heart of it what negative interest rates stemmed from. And the idea comes back to our discussion on bonds, right? We lend out to the government of Canada, we get our nice 2 to 3% return. And that is a fair deal. If I go to Germany and I buy a German bond, I will, lend them my money and pay them 1.5% for the pleasure of doing business. And at its core, I mean, it is a measure of stimulus. It's well intended. You make it less attractive to save on the sidelines. And if I want a real return from my investment capital, I need to go and invest in German companies instead, or loan out to businesses that will give me a better return on that. And what I believe was less anticipated, or at least not anticipated to this scale, was that in this global economy, it became very, very easy to borrow at this, zero or negative interest rate, and you bring it back straight over here, where you can still get a positive yield on your investments. So you're making money on the positive on buying a bond and investing on the positive interest rate side. You're getting paid to borrow on the other side. And then over the long run, the foreign exchange balances out and you make an additional return on the foreign exchange in between. And this is implemented at scale by a lot of larger institutional firms. So I don't believe, and where it's a strong argument that we won't see this implemented in North America due to globalization and what this has done for capital outflows out of negative interest rate economies. Up until the end of the year, that was largely reflective of performance, was largely reflective of our positioning. So we were a bit overweight on the US. This was US leading the pack in terms of performance. Canada, and just not not far behind. And then the European and larger capitalization developed international equities, emerging market equities, and fixed income returns. Still less exciting returns, but still in the positive territory. And you can see what has happened over the past quarter. We'll come back to a little bit about what's unique about this pullback here, because it was really the speed at which this happened is not something that we've really seen before. We'll also talk about what was done in response comparative to what we saw done in response for both the 2008-09 and the dot-com as well. But part of this pullback, part of this process, of course, was the one that everybody's talking about. It was the COVID-19, and this has been a developmental process for all players involved, really. We look back comparatively, and we had to start out through the lens that, okay, what is this at the end of the day? Is this another avian flu? Is this SARS, H1N1, Ebola? And that was as far as you took it at that point. The reason being that, every single year has had its challenges. And it comes back as well to our discussion about timing the market. And I had written this down as well because, why weren't we more reactionary to this? Well, in 2019, we probably should have been more reactionary then to a trade war escalation and the fact that stocks were at record highs. 2018, stocks were at record highs as well. We also had trade wars emerge, and we had rising interest rates, which was the central banks deciding, hey, we're going to try and cool this down. 2017, stocks still record highs. We had Bitcoin mania. That was a real threat to the currency system. And, were we going to be able to maintain stimulus measures if this other currency was emerging? 2016, we had Brexit. 2015, a Chinese stock market sell-off. 2014, oil prices plunged. This was our oil and gas crisis. 2013, the Federal Reserve finally said, hey, we're going to cut the taps on all the stimulus from 2008. There was another major market concern. 2012, there was the debt crisis in the U.S. 2011, the Eurozone. 2010, sovereign debt crisis, and it goes on. But that was 10 years of every year the major threats and why it was a poor time to invest at that time. So it had to be a gradual evolution and a monitoring, and we did put into place in the beginning of the year, as this was emerging and growing within the Chinese economy, more contagion measures and more indicators that we were looking at in terms of how this was spreading and how serious it was becoming. But had we met back in January, it was still in that state where it was being viewed as another epidemic that will largely be controlled. February 18th was where we started to see the exponential growth in nations outside of China. February 26th was our first major de-risking where we were removing a lot of our equity weighting. If we were to look back as to where we were coming out of the end of the year, we were a little bit over on equities, not as much as we were, but about 2%. Through 4 de-risking moves, as this has progressed and developed, we're now down on our equity weighting by 7.5%. So a total 9.5% under on the equity side of the equation. Comparatively, if we were to look back at 08-09 in our last recession, we had also pulled back 10% on the equity weighting. And I'm sure that we were having a lot of the same discussions at that time. And still, it's, I mean, a justification for those of you that were invested through that time that made it through. You had a lot of your growth based on the decision making that we made based on our opportunistic views through this pullback. So we're still in that territory right now. There's a lot of institutional money and larger players at this point in the same stage where we're pulling different levers. We're making portfolio adjustments at all levels, and that's driving a little bit of this stall that we've seen. But it's going to come back to the fact that we're not sure that we're out of the woods at this point quite yet. The other major threat that we saw really that dumped literal fuel onto the fire for this coronavirus pandemic was the feud between Russia and OPEC and what that did to oil prices. So it was a really opportune time for Russia and OPEC to play a game of chicken. And the way that you play a game of chicken for oil prices is you say, as Russia, I'm not cutting off my taps, you cut your taps. OPEC bounces back, I'm not cutting back my barrels of oil, you can cut your taps. And the cycle just continues, and especially these are two very, very stubborn and proud economies that have been pretty unrelenting, but it stemmed from the fact that Russia was looking at the fact that when they did have agreements to taper oil production between Russia and OPEC, the US was really stepping in with their shale production to be able to fill that void anyways. And of course, there's been enough Russia-US tensions lately, and they've been not afraid on the Russian side to be able to be an instigator for issues like this. But it largely led to the consensus decision or lack of consensus decision, where Russia and OPEC did not come to a deal, and there was to be no restriction on the level of production of oil within the global economy as at April 1. So we saw the largest declines in oil pricing that we've seen in quite a long time. This is even just the Brent global oil index, and it's comparable with WTI crude. It's a higher quality oil than what we're used to in Canada. Ours is very, very crude. It's very coarse, very heavy. There's additional refining involved for a Canadian product, and then we have our own socio-political challenges with being able to get oil to the market as well. So even if we do go through all that process, this has had quite a price cut on the global level on this finer oil. We are not even really on the map down here, and this has really furthered the case for hampered growth within the Canadian economy, in that our energy sector is so vulnerable already, was so very leveraged in building up infrastructure and facilities to be able to harvest and process our oil back when oil was persisting up at this level. You know, coming into 08-09, when we were at the $100 a barrel level, was when we really doubled down and said, hey, okay, I want in on this market. Let's put some spending out there, particularly in Alberta, to build up our capacity to be able to do so. Well, when oil prices crater on the global level for even a finer product than ours, our outlook for the Canadian energy sector is significantly hampered at that point, because we're so far behind being able to be a major player in that market that we'd have to see a major recovery in oil prices before we could even think about participating again. So that was more of a detriment to the global economy. It hit some very energy sector reliant businesses and companies countries globally, and was part of what was drawing this pullback. So At the end of the day, where is our positioning based on the pullbacks that we've seen? Well, we're significantly underweight on equities relative to fixed income. We're still preferring the security of having our stable fixed income investments. What we're seeing is a measure of a lot of stimulus coming from both the central banks, coming from the governments now that are trying to prop up liquidity within the banking sector and the credit markets. But we're still, at the end of the day, looking at reduced demand due to this coronavirus pandemic and the level of shutdown that we've had. I wanted to show this as a context for something that we're really still looking to as a leading indicator going forward, as we look at a week by week of the new unemployment claims within the US. And this is to go back to the 60s, just to really give some ideas to the scale and magnitude in the spike of unemployment that we've seen over the past 2 weeks. The important part about this is we're always asking, okay, well, is this 30% pullback that we've seen on the markets priced in then? Is this it? Are we at the bottom? Well, the expectations coming into these announcements, so the week before, the major US banks had said, okay, well, I anticipate that with the slowdown, we'll see 1,400,000 job applications EI applications in the week to follow. So of course that came out and shattered it with about 3.3 million jobs lost in the US. The week later, the expectation was, okay, wow, that was really bad. Maybe once again we'll report another 3.3 million jobs. The week after, the figure came through at 6.65 million jobs. The forecast at this point right now is for a repeat of last week, for around 6.6 through the major consensus. So that is going to have a ripple effect throughout the economy, because when you do have an out of work worker that otherwise would be earning an income, had capacity to spend, because at the end of the day, we're investing in a sliver of a company, right? Their equity, their stock, it's their cut of their earnings. And if they don't have a demand there that's going to actually generate those earnings for us, that's not long run positive for equities. We need to see some improvement and some containment in this pandemic, and we need to see things like this improving. We need to see people back to work. Of course, we need to as well be able to make sure that we're adequately positioned for when that does happen. And I'll talk a little bit about what that looks like as well. But again, to combat, we've heard the bad. We've heard about all the factors that have been leading into this volatility. So where is the upside? And this is kind of what we need to continuously monitor, is to where we're at in the business cycle and what tools do we have at our disposal to be able to deal with that. So this is a business cycle. If we're looking at it very simplistically, and if you can understand this wholly, then you too can direct policy for a central bank. If you understand this even half as well as being fully understood, you'll still do a better job than Alan Greenspan. So understanding the relationship between yields rising and economic slowdown at the end of the day is what we're after. Because what we came back and saw was that we did have bond yields rising up until the end of 2019. This is something that you generally see at the end of a business cycle, and it's the role of the central bank. We say that they're the chaperone that is supposed to step in and yank the punch bowl out of the party before things get out of hand. And that is, you're supposed to be raising rates at that point in an effort to cool things off before we get too high in the business cycle and before GDP growth goes too high, because we're after this long run normal regular GDP growth. Over the long run, we need to be able to smooth out this curve. So if we're looking at this is real GDP over time. Sorry, one sec here, technical difficulties. Okay, I think I have my mouse back. But there's a relation, right? So if we raise interest rates within the economy, it discourages lending. Workers and businesses don't have the capacity or the facility to hire on more people, and it is a means to slow down the economy. Moving on from this one here. And part of that is coming back to, okay, so how does this money supply work? So Who has the power to create money within the economy? Well, it is the central banks. And I do hear a bit of a misconception when I do say central bank, because a lot of people think, well, RBC, TD, CBC, CIBC, and so forth. Central bank does not mean any of those. Those are the commercial banks. But the central bank is an entity that's supposed to operate independently of the country's government to regulate and control the monetary supply. So in the US, that is the Federal Reserve that we're looking to. In Canada, that is the Bank of Canada. Looking to the Euros, the European Central Bank, and then the People's Bank of China. China, it goes so far and so far. But they regulate what is available in terms of Canadian dollars, US dollars, and it's a way of measuring GDP as well. Because traditionally we think of GDP as being a function of consumption by the consumer. It's investment, it's government spending, and then it's an adjustment for our exports and our imports. But the other way to look at GDP and growth and what we'd want to see improving in an economy is being a function of the money supply, the level of cash that is in the economy, and the velocity of money. Because conceptually, if we think about that, so we've got a money supply. This is money that will flow into the banks, and then the banks will lend out to both consumers, businesses, and governments to finance their spending needs. So if we have to develop infrastructure, if I'm a consumer and looking to buy a house or finance a purchase, if I am looking to expand my business, build another facility, hire on more workers, I'm in need of cash in order to make that happen. So I will likely borrow that from a bank. Well, a bank maintains a reserve of cash and equivalents that they're able to lend off of, but they do need to maintain reserves as well. So they might lend out, but to maintain those reserves, they'll have to borrow from the central bank, and the central bank is setting, what that rate is that they're going to lend out to, your regular banks. And that is when we look at, these bond yields. Why are they up at 2.5%? Why are they now down at 1%? Well, it's driven by what the central bank decides to lend out to the core bank for. The role of this intermediary, this commercial bank, we'll say, is to then say, okay, I'm able to borrow for the short term at this rate and finance my reserves. I will lend out for a longer time horizon to a consumer or a business or a government, and I make my money based on the differential in interest rates. So of course I should charge more to lend out for a longer term than what I'm financing for over the short term. So the central bank gets a lot of power in this regard to dictate the interest rates within the economy and therefore encourage either spending or lending or tighten things up. They might pull money out by selling bonds instead, reduce the money supply, increase interest rates, and slow things down. And that's how we saw them, back off in the end of 2018, come do a full reversal, say, hey, we need to keep this economy running, keep the velocity of money flowing through this economy in order to keep things running, keep valuations up on the equity markets, keep people employed, and ultimately keep this running. So that is the first tool that a central bank has at its disposal, is the ability to set rates, increase this money supply and the value, the velocity of the money running through the economy. The secondary, and what we've seen really come through initially, and this is kind of a bridge between these other tools, is repo agreements, where they'll say, okay, well, you have reserves, and these are generally sovereign debt, as there's in the U.S. Treasuries. These are federal bonds, and they will say, okay, I'll lend you money to be able to support your needs, support your reserves, and you can lend out on it, but I'm going to hold one of your bonds as collateral. And it's a really short-term agreement. This will unwind itself very, very fast. But one of the first measures of stimulus that we saw beyond going to 0.25 interest rates was the addition of these repurchase agreements. So it was an injection of liquidity. And the final, and what we saw really emerge through 08-09 was the notion of this quantitative easing. And this started out in Japan in 2001 as an experimental policy, and we wouldn't see it again until we got to a point where we were already at, 0.25% interest rate back in 08-09, and said, well, this isn't working anymore, because when I'm trying to inject money into the economy, people would rather just hang on to that money than invest it because cash is king right now, and it's what we call a liquidity trap. So how do we break out of this? And the measure is that, well, the central bank expands their purchasing. So they'll look to buying government bonds, not just, in the short term, but they'll look to a 5-10 year time horizon. And it's not even just direct lending to a bank. They will go out and purchase these bonds from pension funds, from insurance companies, from private firms such as ourselves, and major retail banks. So a couple of things happen in response to that. These entities, these insurance funds, now have more liquidity to be able to meet their cash flow needs. If a pension fund needs to pay out a pension for retiring employees, they have the liquidity and ability to be able to do so. But it forces as well investment firms like ourselves to reevaluate and say, okay, the central bank has emerged as a major demand for these bonds, not only for the short term, but for a long term. We're going to have low interest rates for quite a very long time. And if I need to meet a higher return requirement than that, I need to go elsewhere. So it forces us to do a rebalance and seek risk assets once again. This is us looking for this opportunity right now to go back into equities and find out what is a resilient company that'll give me a return above this low fixed income yield that I'm looking for. Across the board, this quantitative easing leads to what we call the wealth effect. Whereas as that happens, as more money flows into the equity markets, once again, people start feeling empowered and more opportunistic. They have a more positive outlook on the direction of the growth of their wealth and finances. That in turn leads to them turning around and kicking up spending once again, because I'm confident the way things are going, I can increase my lifestyle spending. I can go for that purchase that I can attractively finance now because rates are so low. Businesses might look and say, okay, well, rates are going to remain low for some time. I have no problem expanding my business, which in turn will boost my share price and my earnings over time. So it's a way to spur demand and get the gears going beyond our core tool of reducing rates to a low zero. That provides a whole bunch of an injection of liquidity to the economy, a means to transact, and at the end of the day is geared at spurring aggregate demand and bringing back that consumption aspect of real GDP growth. So with the understanding of those tools that we have at our disposal, what did that look like in 08, 09 versus right now? Well, we started out, at the same starting point, really. So we were at 2.25% coming out of, Q1 2008. And there were, signs of trouble that this had been quite a significant rally since the early 2000s after the dot-com crash. Maybe we need to start reducing rates and prop up a little bit early the economy and make it more attractive to borrow, get some activity going. The rates would continue, but you'll see we waited, about 5 or 6 months to see what the impact was of those rate cuts. It was very much a wait and see approach by the central banks, the Federal Reserve in the US. When things started getting more heated on the markets and we saw a bit of a pullback and there was an uncovering in the quality of a lot of this debt that was on the market, of course, the first tool that we ran to was further reduction in the interest rate. This is the first time in November 30th, 2008 that we would see quantitative easing emerge in a North American economy. So that came out with an initial stimulus package where the central bank said, I'm going to step up and I will buy $600 billion in your bonds from all of the entities that we mentioned, and you inject $600 billion of liquidity into the market to be able to spur things up once more. We'd still see further rate cuts beyond that. We would see even beyond this chart. 2010 would be another round of $700 billion in quantitative easing. We wouldn't actually dial back this quantitative easing program until 2014, and even then only for a very short time. So how does that contrast with what we've seen pretty recently? Well, we started out very much the same. Of course, the first tool at our disposal is let's start cutting this interest rate down to where we can encourage spending, encourage borrowing, get things going. So we started that out. Let's take a wait and see approach for 2 months while things are still looking okay, but we're not really, we're not really going to be able to offset a downturn, and global growth is slowing. So let's make some more tapered reductions in the interest rate to be able to get things going. And then we saw, obviously, look at the severity of this pullback, and this has been unprecedented. And this is due to a couple things. If we look at the rise of passive investing, where we came back to, there's a lot of investors now that are just following this passive strategy. They're very easily startled. There is no management of their funds to advise, hey, now is not the time to sell off when we're in a down market. So there was a large sell-off in these passive funds, to the point that the central banks, beyond even just engaging in this bond buying program of QE, were stepping up and saying, well, we might have to actually provide liquidity to these index ETF funds because there's such a flight out that people are trying to run to cash, and it's disconnected from the value of their actual equity holdings. So the central bank almost had to step in on that front. They haven't written off at this point the fact that they may and might have to, much like they did in 08, where we had an emergence of this program called the Troubled Asset Relief Program, where we expanded, or the Federal Reserve expanded the types of fixed income securities that they would buy. Bought mortgage-backed securities to remove a lot of this toxic debt off of a lot of bank balance sheets. That type of stimulus is really not off the table should this continue on this trajectory. But what we see in March here is just the volume, the sheer bomb of stimulus that has been dropped on this market. So we had a 50 basis point drop from the Federal Reserve March 3rd. There was the initializing of this $1.5 trillion repo agreement availability. So this is more of we had mentioned the bridge kind of financing to keep things rolling. Between March 14th and 15th, we had both another full percentage basis point drop on the interest rate, as well as a pledge to spend $700 billion on quantitative easing, so injecting money into the economy. And that lasted all of 9 days before the central bank said, hey, there is no limit to the amount of money that we will drop into this economy to keep things going. So we call this infinite quantitative easing. It's not to say that, okay, we're just going to do this all at once, but here is a program where we're going to buy X amount of bonds off of the market per week, and we will cut off the taps for that once we see signs of recovery. And that's driving a little bit of some of this rally that we've seen over the past week and a half, roughly, is this reassurance and full support from the central banks in terms of accommodative rate environment, in terms of stimulating the economy through quantitative easing and providing additional liquidity through repo agreements. But right now, we're in this territory. This is where we're at, is dealing with this pullback. And we're trying to sort out, has this been priced in? Will this be a 2-quarter ordeal with regards to COVID and this pandemic? Is that reflective of the growth that we should expect going forward? And have these stimulus measures been enough to set the stage for our recovery? A lot of sentiment that we've seen lately has been in the direction that we're not going to see the sharp V-shaped recovery. And if we go back to the equivalent in 08, 09, well, we saw the stimulus come through in a very, very short time horizon, not to the same degree up front. It was enough to stall things, but we didn't start seeing recovery until we saw a lot more improvement on the economic front. And it's very, very possible that we'll continue to persist in this environment after what we've seen after this stimulus response for quite some time, until we're able to see. So we're still sitting here at this point, taking a look and saying, okay, what is containment like? Are businesses picking up in response to this stimulus, or are they able to borrow? What is the employment situation looking like, particularly in the US, because they've been quite substantially hit. Canada as well. I mean, there's lots of businesses, much like we're doing, that are fortunate enough to be able to work from home, but there are many that are not. We're shutting down our entire restaurant and entertainment industry, and that's going to really hurt the power of the North American consumer. So we're just still sorting out right now at this point, and tactically waiting on the opportunity to go more risk on and more in the direction of equity markets. Market will come back. We know we're not going to try and time it based on our investment philosophy. The general trend is upward, always has been, and we'll reach a point where this pullback will be a minor blip. but we're not in a position to be able to tell you, okay, this is the week that we're going to do that. You'll all be well informed, and I'll be putting something out once we have made that decision to be able to return to risk assets, because I've been instructed by our tactical team that we're not looking to do that in the small and calculated way that we had done for the de-risking. We're looking to go largely back into risk assets, so it'll be quite a substantial move for us. And granted, there will probably be a couple months there where we will look silly as we return to equities, and things may decline in the short term. We're not going to be able to call that bottom to the degree that anybody else can. But we are going to make a significant move, and over the long run, expect to be well positioned for growth once we are able to show signs of containment and recovery. And it's not just in the equity markets, because right now, even on the fixed income side, we have to look to, where are we best to get our yield? Is it us going for the short term, those 2 years? Is it us going for a 10-year, a 20-year? What's going to compensate us the most? And part of this has been uncertainty in these corporate side of the equation. So companies looking to borrow money as their outlook is not looking so certain right now. We're concerned largely as to their ability to meet, these debt and cash flow obligations. So because of that, we demand, if we're going to give them money and lend it out to them, well, they have to pay a higher premium because there's an element of risk involved. Right now, we're still not at the point where we're confident that they will be able to deliver regardless of the yield that we set, but there will come a time where we are still demanding a higher yield from the corporate side, and we're more certain about the solvency of the company, where we might lean more in the corporate direction for fixed income. And this comes back into your alternative investments. A portion of that is what we call strategic yield, and it opens up the doorway more for us to be able to capitalize upon opportunities like that. Alternatives as well gives us exposure to the smaller companies, smaller and mid-capitalization companies that are going to see some explosive growth if we're able to really weather this effectively. So it's building up a position in those asset classes, much like the fixed income was there to outperform through this volatility, and much like your equities will perform in a period of strong economic growth. The alternatives serve as a further diversifier, and everything that is in your portfolio is in there to serve a unique purpose. Today just happened to be fixed income's time in the sun, but we've had a good long 10 or 11 years with equity market returns in the sun. We're right now just at a pivotal point where we're looking for our next opportunity to bridge that gap and return in line with what you're looking for, and not just preserve the capital you have with us. So that's the lay of the land in terms of our take on where the markets are at. But I would like to open it up for any questions, or Stephanie, if you're on the line and have received anything quite yet, if you could let me know.
No, so far we haven't received anything, but please feel free to type out your answers, or if you prefer raising your hand one by one, we can unmute your microphones if that's a preferred way. We can do one by one.
I'll give it 2 minutes. I mean, that's a lot of information, and that's why I wanted to have this as a separate session, is that, a lot of the time we'll focus on the other aspects of what we manage here. I mean, we're not just here as investment managers and trying to create value on this side of the equation. We're here to be working with your accountant, working with the legal consult, and making sure that our strategies are all working in the same direction with the other professionals that you're working with as well. But it was mostly just to give you an idea as to a lot of what we look for and the signals that we'll need to see before we head in direction of returning to, we say, risk assets or equities. So just coming back to that, the first question, is now the time? I hope that is 5-year money, and I've sat down with many of you that have asked me the same question, and my standard response, if we're going in an equity strategy for contributing new capital, is this at least 5-year money? And if not, I don't want it in this strategy, because we might have a period of volatility, much like we're seeing today. But we know over the longer run, equity markets will outperform, and the general trend is upwards. So if it's socking away money for still, retirement down the line, I would say we do have some very, very attractive valuations. If we're looking back at where we're at relatively for the growth over the past year, well, as at yesterday, we're back to about May 2019 to put through things in context on the U.S. market. So will we reach those levels again? Yeah, I think there's a very strong case, and the central banks, the government side, is doing everything they can. A lot of what we talked today about in terms of stimulus was strictly the monetary side of the equation, those three toolboxes that we have that the central banks take care of. But the other side is the fiscal response, right? It's still the government that can step up to the table after that and provide direct stimulus. We see this in the Canadian side with the Canadian government stepping up and giving benefits of $2,000 monthly to people that are out of work due to this pandemic. On the U.S. side, it's quite something for them to step up to the table and engage in transfer payments of $1,200 to their citizens. So there is still another aspect of stimulus that is unrelated to the central banks, and we're going to have to see what that looks like, where that capital ends up, and then hopefully it'll be investing back in the markets.
So I have a raised hand here. I'll just unmute that microphone if you would like to speak up.
Oh, hello, Ryan. Oh, trying to step back from the microphone a bit. It's Chris Green. Are you hearing me okay?
Yep, you're coming through just fine.
Okay. So first of all, I want to start by thanking you for an excellent presentation. I found it really helpful, and I especially appreciated the bit about the explanation about bonds. I found that very useful.
Right.
There was a front page article in this morning's Financial Post that suggests that we may be at the bottom of the fall. What's your thought about that? If I could also just add a slightly sort of tongue-in-cheek question, is this a good time to buy shares in funeral homes?
Shares in funeral homes. And while we're at it, why don't we add the cruise lines and the airlines while we're at it, right? But I mean, it is now the right time to be deploying cash. And I mean, if we were to look at that back in 08, 09, I mean, just look at the path of returns that we were seeing at the time here. So I'm trying to get my pen back here once more. We were saying the same thing right here at this point. I mean, we'd seen a bit of a bounce back. I mean, accommodative policy from the central banks. We need to be aware of the fact that there is still some pretty negative economic news coming our way. So I'm not of the belief, and I speak independently of the firm when I say this, that the market is not adequately pricing in the pullback in employment that we've seen. I don't think you can take a $10 million jobs lost within 2 weeks lightly. When if we go back to your core equation for GDP and GDP growth is consumption, investment, government spending, and then exports. In the U.S., this consumption aspect is 70% of the economy. When we then wipe out the demand and the ability to consume for what accounts for 70% of the GDP growth throughout the U.S., that is quite detrimental. And if we were using China as the example as to what that does in terms of fallout, then no, I do believe that we could see some further declines based on reduced purchasing power at the end of the day. Is now a good time to be buying funeral homes? Well, potentially, but I don't know enough about this virus to say that that's not a risk in itself. And that I know there's been some challenges in being able to handle post-mortem people and being able to adequately process them. So I could see that being a mess all to itself. But aside from that, it's definitely outside of our risk tolerance, and the speculative nature of it is outside of what we do for our portfolios here. There's and I'll throw it out that there's a couple that have been interested, a couple of my clients that have asked the same question and arrived at a response as to, I'm in line with the firm's views. And there's a couple that I've lined up to contact with regards to sidelined cash when it is implemented on our side that we're feeling like we're returning to risk assets and equities. And if that's something that you'd be interested in, then I can definitely reach out to you once we are of the view that sentiment is improving and we feel that there's a case for growth going forward. But again, we're going to be in that territory where we might look silly for a couple months there.
Thank you. Does that answer your question?
Oh, yes, very, very well indeed. Thank you.
Thank you. We have a few more in the chat box. So the first one being in regards to RIFs, if we can reduce the withdrawal rate at this time.
So if you are at this point taking the minimum amount out of your RIF, you might have seen that yes, there was a government relief measure as part of this pandemic that you are able to reduce the amount that you are taking as a minimum. So if you are set on our system right now to be receiving the minimum payment, then that will be automatically implemented for you. For those of you that are currently taking above the minimum amount, then we will have to actually implement that change for you. So if you're of the view that I really just want to remain invested, don't want to be pulling out money to, that I don't necessarily need to out of the RIF to fund lifestyles, then I have no problem moving you back and taking out the bare minimum out of the RIF such that you can remain invested and not miss out on the uptick that we're anticipating. So it will be automatically done. In short, for anybody that is already taking the minimum, if you're taking above that, please reach out to me, and I have no problem putting a cancel or a reduced amount going forward from the RIF.
Perfect. Thank you very much. The next one is not much of a question, it's more a statement. So the statement being, I worry about the next generation shouldering the government's payout. They will have short-term gains, but a lot of government debt. And then they also thank you for your presentation.
And that always is the concern, right? And that was something that we saw play out in 2011, 2012 was reaching the limit, particularly in the US, as to the level of debt that they could take on. And yes, it is a long run concern. Even the unwinding of this quantitative easing program that eventually the markets became reliant upon. When we did try and shut the taps on that, that became the crisis or the market event of the year in 2014 when they said, okay, well, we're going to stop this bond purchasing program. But in times like these, the government relies upon that stuff because when they issue, when they're looking to borrow to be able to spend this and create transfer payments, they issue new sovereign debt, and the central bank steps up and buys that. That's part of what this quantitative easing program is. So yes, they are increasing the level of debt on the government balance sheet. It will have to come from somewhere, and politicians have been largely unsuccessful because the way that you combat this level of debt is to increase either output or taxation, right? So output is not as easily influenced as being able to influence the tax rate. However, you become a very, very unpopular politician if you increase taxation. So it is going to be, a little bit of a shift here for the Republicans in the U.S. to all of a sudden be turning around and paying out to the workers $1,200 as a benefit for this. There was that argument that said, well, we had Bernie Sanders out there. How much money does it take to turn a Republican into a socialist? Well, apparently it's $1,200 because now this looks like an appropriate stimulus measure. But yeah, I can see that absolutely being a dictator of government policy going forward as people kind of start having to realize the consequences of taking all of this debt onto a federal government balance sheet.
Thank you. We have a question in regards to the presentation. Someone wasn't able to hear during the whole presentation and they wanted to know if it would be available for review later.
Okay, and Stephanie, I believe
So
we talked about that. Was it this was recorded?
Yes, this presentation is recorded, so I was just wondering if you did want to send it out.
Yeah, so I'm going to find out what the file ends up looking like for this. So I'm so sorry that you were not able to hear. I do have a couple that I was following up with as well that were interested but not able to make it today. but I'll be finding a way to distribute, even if it's just sending off personal links. But I'll get you a presentation that has the full audio. Okay. Does that just about do it for questions there?
Yeah, we have a few thank yous in the chat box, but no more questions have come in so far.
That's awesome. Okay, and great. Thank you all so much for taking your time today. Again, a sincere thank you to the medical community that is really on the front lines of this. We're here to do anything we can for you to make things easier for you to give your best in that regard. And if there's anything that comes up after the fact, if there's anything that is more personal to your circumstances that you didn't want to speak up about here, please always feel free to reach out, and I'll be making this available to as many as I possibly can. Thank you so much.